Welcome to the ETF Show, taped here at the Asset TV studios in New York. I'm your host, Kristen Myers, ETF Editor-in-Chief for Asset TV. Now, what should be a surprise to no one, investors have been seeking safety as markets have been on a roller coaster ride. In March, ultra-short bond ETFs pulled in about $25 billion. That's nearly a quarter of the $104 billion worth of inflows that went to ETFs last month. The figure is also more than double what the category attracted in February. Here to discuss more is Jason England, Portfolio Manager and Fixed Income Strategist at Simplify. Jason, thank you so much for joining us today.
Yeah, my pleasure. Thanks for having me.
So, Jason, I just mentioned some of those figures. I'm wondering if you could just set the scene for us a little bit here. What's really driving that shift? Is it, just the US-Iran war and conflict, just that volatility?
Yeah, I think it's a lot of the volatility. So what you've seen really is, once the war started, we saw the spike in rates, across the whole curve. Really, where you saw rates peak, for 2 years got as high as 4%, 10 years 4.5%, and really what you start to see is, people were trying to get as short as they could in duration, whether it's all the way down to money markets or into, these ultra short funds, but really you started to see that peak hit. And then at some point you realize, okay, if this economic surge of oil and the energy shock continues, then what is the impact to growth in the economy? And that's when you started to see rates normalize a little bit, came back down closer to the middle of recent ranges. And that's where you saw, maybe that, safe haven status in treasuries return. So I think people started to see, or investors, that maybe this is a good entry point in fixed income. So you saw more and more people enter the fixed income universe.
So, how do you think investors really are then thinking about, rate risk, especially as we have seen a lot of those inflows going to those ultra short bond ETFs?
Yeah, I mean, obviously, the biggest risk to rates right now is inflation. The Fed's been running above their 2% target for over 5 years now. We've talked about it ad nauseum. Now, they've obviously come down quite a bit from the peaks we saw back in 2022. But you're also seeing that last leg from that 3% down to their 2% target being very sticky, and so it's really kept the Fed, on somewhat on hold, and they've been able to do a little bit, over the last 2 years as far as easing rates, but it's kept investors really, really anchored towards the front end and not wanting to go too far out the curve, and adding more duration. So that's kind of what's seen, flows into fixed income's kind of been stuck into the closer to the front end because of this rate risk that we've seen, because inflation negative for rates, and we saw it with this oil shock. Rates shot up as soon as the oil prices surged.
I'm curious to know how you sort of think about the role that ETFs are really playing right now in this whole conversation, especially as we think about these cash alternatives versus, the more traditional money market funds, especially that we now have these money market ETFs. I know Simplify has one as a part of its suite.
Yeah, cash alternatives has been a pretty popular asset class, call it over the last decade maybe. And really what you've seen is you know, with historically rates have been over the last 2 decades very low. So hanging out in cash or money market type vehicles didn't have attracted enough yield. So you've seen investors wanting to get more yield. So they extended out a little bit outside of that first step out of money markets into these ultra short vehicles because they want more yield. A lot of these are, more credit focused ETFs. So you're getting more yield in them, but yet you're not taking that extra duration risk. You're not going out the curve enough. So really wanting that extra yield without taking much interest rate risk in your portfolio. So that's where you've really seen them become popular. And ETFs have really been the vehicle of choice, because you've seen more and more firms try to meet this investor demand by launching ETFs that are ultra short. Like I said, mostly credit or asset back type strategies.
Is there a downside, or what do you see as the downside, or, the opportunity cost for those investors that are just, either sitting in cash right now or these, ultra short term ETFs?
Yeah, I think there's less downside right now. As I said, in the last 2 decades, we've only seen, yields in money markets above 3% twice. And one of them's in the current period. So the attractiveness and the safety of hanging out there. Because if you've seen over the last couple of years, rates have been very volatile. We had the tariff tantrum last year. We have the war this year. So you've seen rates kind of go surge up and down. And so people that don't want that interest rate risk in their portfolio, but yet want a little more yield, you know, hanging out in money markets or ultra short provides some yield but less interest rate risk. So a little bit more safety and cushion in their portfolio is what they're looking for in these strategies.
Do you think fixed income is a crowded trade right now, or is it at risk for becoming one?
Nah, I mean, I don't think so yet because we've seen over the last, several years, we've seen this move out of fixed income and even equity in your 60/40 portfolio into alternatives. So even though we've seen flows like you've highlighted at the top of the show into fixed income, we're not really seeing huge flows. It's a huge, deep, obviously 31 trillion treasury market. It's a huge and deep market. So it's not crowded to this point yet, I think, because we've seen other asset classes like alternatives take up some of the allocations that we would have seen to fixed income in the past.
I'm curious, you were mentioning, the front end of the curve just a moment ago. Where are you really seeing the value in fixed income right now? Is it just at the front end of the curve, or are you seeing value elsewhere as well?
I mean, I think the value, to break it down in these geeky bond terms is, credit risk hasn't been compelling. It's been somewhat complacent, historically tight levels. We've actually seen some widening more recently with the war, but really historically tight levels over the last couple of years. Directional risk is somewhat challenging, trying to pick, how much duration you want because of the rate volatility. So convexity risk is really the most compelling, and you can get that in treasury option income strategies, um, where you're looking to capture rate volatility, but in range bound markets, enhance your yield by selling options on treasury futures. There's demand for that because people are constantly trying to, hedge their interest rate exposure. So they're buying options. So if you're selling on the other side, that structural demands increases the premium. So that's kind of the area in fixed income we feel is the most opportunistic right now because you're not taking credit risk. You're doing it in the treasury market, and you're also not taking a lot of duration risk either. But you're being able to enhance your yield through this treasury option income strategy.
Are you seeing investors, really take advantage, you think, of some of these, better or more sophisticated strategies right now? Or do you think that they are just kind of using that cash as a placeholder?
I think because of, like I said, we haven't seen, cash with this attractive levels and, only twice in the last 2 decades. I think it has become a strategic allocation in portfolios now that you want to keep some cash on hand. And it's twofold. It's a strategic allocation to cushion and buffer your portfolio. You're still getting, like I said, above 3% yield. So still collecting some yield in your portfolio. But then it's also that, dry powder for when you see opportunities, whether it's in going back into the equity market or going out the curve in fixed income. So it is a, kind of a place that, bond and stocks, over the last couple of years have been very tightly correlated. So if you want to find a place to hide out, that front end has kind of been, sitting in cash hasn't been that bad of a place to hide out.
How quickly do you think investors are going to unwind out of that sort of position? I mean, because as we're taping this right now, right, the S&P 500 has essentially erased all the losses that it saw from the U.S.-Iran war. The market is moving pretty quickly right now. How quickly do you think the investors are going to move with it?
You have over 8 trillion sitting in money markets right now. So I think it's going to be a slower move than people will think, just because as I've highlighted a couple times now, the attractive yield you're getting, if the Fed comes in and has to, cut rates drastically, back down to the zero bound, and, money market rates go back down to that zero to, very low levels again, then maybe you would see the flows come out much quicker. But I don't project that. That's not in our base case. So I think you'll see some stickiness there in money markets. You'll see people hang out for a while longer. I think eventually, like that, having that dry powder, you'll see some move, but 8 trillion is going to take a lot to move. So it's probably not going to be fast moving out of money markets.
So specifically looking at Simplify's products, anyone that's ever seen the list knows that you guys have a pretty robust fixed income suite. Also have a money market ETF. Can you talk me through a little bit of the strategic approach that Simplify takes, and really how you see sort of Simplify fitting into this more cash alt conversation?
Yeah, sure. We have a couple vehicles that kind of fit in the cash and the cash alternative, asset class, and really, the government money market 2A7 ETF that we have. We're one of four ETFs out there now. Obviously, you have your traditional government money market funds, but the move to ETFs and us being an ETF shop, we really wanted to, it was twofold. One, we wanted to enhance our internal cash investing through a singular vehicle where we could limit transaction costs, operational efficiency, as well as enhance yield for our investors in our other funds, but also to get access to other investors to a money market ETF that has a low fee. 15 basis points is all it is, so relatively attractive. Still in that 2A7 universe, so it's not really outside what the traditional money market mutual funds are doing. But with our skill set of trying to maximize yield in there, it's something we've tried to do across all of our portfolios. It's give a different option in the ETF wrapper for our end clients. So that's the money market ETF. And then we also have BUCK, which is our treasury option income strategy, where we have a base beta portfolio of money market securities, and then we're doing that convexity risk or that treasury option income on top of that, trying to enhance yield more. Limited duration, still targeting 1 year or less in duration, little to no credit risk because you're just using treasury market. And we're getting, anywhere close to low 7% yields there. So it's a slightly obviously more volatility than what you're getting in a money market fund, but it also gives you more yield without taking on more credit risk. And in today's market, as I said, credit's been historically tight, somewhat complacent, I feel. So it gives you another alternative in that ultra short space that's kind of differentiates yourself from the rest of that peer group.
You've kind of touched on it a bit, but just to kind of wrap it up with a nice bow, really looking out ahead, considering what we've had in the market just in the last couple of weeks and months, what do you really see as bringing investors really firmly back to some of those risk-on assets, or at least to some of those longer duration bonds that we have?
Yeah, I think really it's got to be not just a de-escalation, but a stop of the bombing over there, and an agreement by both sides that the war is going to end and this conflict we can move forward. Obviously, the oil shock is going to be, or the energy shock is going to be, going to continue for a while. Even if they open up the Strait of Hormuz, you're still going to see, a little bit of a shock to that. But really, you need the confidence in that we're behind this conflict. You've seen a little bit, you kind of noted to it that you've seen the, equity market pull back to, almost unchanged since the war started at the end of February. So that kind of confidence will get investors to start getting back into the market. It also twofold gives the Fed a little bit more confidence that they can go back to looking at the data, and seeing eventually they want to get back to their neutral level and they want to ease some more by cutting interest rates. But they need to see the labor market stabilizing and the inflation narrative going back down, sustainably their 2% target. So if you see all that, the confidence in the Fed and the investors in the market that the war is behind us, I think that's where you start seeing more people not just going back into risk assets, but in the treasury market, adding duration, going back into intermediate duration funds, maybe even going out further out the curve. I think that's something more longer term because inflation still is the risk, as I said, in fixed income.
All right, Jason England, portfolio manager and fixed income strategist at Simplify. Thank you so much for joining us today.
Yeah, thanks for having me.
And thank you so much for tuning in to the ETF show at Asset TV.